I'm going to tell you the 3 UK stocks to buy in December 2020, including one that I've personally bought myself. And if you find this video useful, please drop me one of these to support the series. The first stock is listed in the Ftse 100. I would consider it to be a dividend income play for your portfolio. They provide various insurance and savings products and services across the UK, Europe, North America and also Southeast Asia, although more recently they've started to dispose of their Asian assets so that they can focus primarily on the UK and Europe. This stock is Aviva, and their new CEO Amanda Blank has certainly shaken things up and has certainly put the stock in a good direction, such as negotiating the price of the disposal of some of their assets and achieving above a net asset value, which is a positive to shareholders of Aviva. Their price to earnings ratio is lower than the industry and the market, suggesting to me that investors are less willing to pay a premium on this stock, and therefore this seems like an undervalued or overlooked stock. Furthermore, if we compare their market capitalization to their net assets, we can, these dogs just going to keep barking because that is ridiculous. But if we compare this, we can see, or more commonly known as a price to book ratio, we can see that they are also below their industry and market. Although do keep in mind, this is also despite the vaccine rallies that left our UK markets rallying quite a significant amount, including stocks like Aviva and Legal & General, for example. In the last 5 years, they've managed to grow their earnings on average of 27.7% each year, although their profit margins have been decreasing. This is because in the last year they've had a negative earnings growth of 5.3%, and I likely believe that their earnings are likely overinflated due to the disposal of said assets I mentioned earlier in the video. This is also a lower decline compared to the industry and the market, suggesting that Aviva is in a much more resilient and well-placed position, and therefore giving us a reason to buy Aviva over their competitors, for example. Although when looking at the quality of their business position, we can see that their return on equity has been in line with the industry. Currently, Aviva has a forward dividend yield of 6.48%, typically paying in January and September each year, although that's likely due to the delayed payment. I suspect it's more commonly going to be around May and September each year, although this is subject to change. The forward dividend yield is higher than their current dividend yield simply because they expect to pay a final dividend in 2020 of 14 pence, making their total 21 pence. I am sorry if you can hear those dogs barking. They've literally been barking for the last whole of the lockdown, non-stop. In the last 20 years, Aviva has managed to pay a dividend each and every year, although there has been quite a few dividend cuts over that time horizon. If we look at the compound annual growth rate of their dividend in the last 10 years, we can see that they've actually had a negative growth of 6.14%, suggesting that their current dividend is obviously lower than it was in the last few years, and they had cut it during the peak of the pandemic. Although they've stated that they plan to reset their dividend, so it's likely going to remain lower for the next few years, but then it at least provides a new set of growth for newer investors in the stock, and likely will continue to grow at a faster than average pace of the market going forward. Although we've seen this quite often, so it might be quite cyclical, and in 5-6 years they may cut it again, which doesn't bode too well for investor sentiment and would make sense as to why they are priced lower than their competitors in the industry. Although their payout ratio of 23.4% is a bonus and does give them a lot of room to grow that dividend in the future. Aviva has a great balance sheet in which their short-term assets outweigh their short-term liabilities, but not their long-term liabilities. However, Aviva is a financial institution, and I very much suspect that they have to price or write off bad debts, leading to a lot of higher long-term liabilities, therefore making the balance sheet look worse than it actually is. If I'm wrong, by all means leave a comment down below saying exactly why this is. Regardless, this is completely redeemed by their moderate debt to equity ratio, but their cash position, which is over £19 billion, and at least assures us that their dividend is likely going to be paid in the next few years, and they've got room to grow it should they need to. If you'd have bought shares of Aviva in the last 5 years, you would have gotten returns of minus 18.1%, although this is still accounting that they are down massively year to date. Although I believe that this is a dividend recovery play and that they show a lot more promise with new management. I think they're in a sector with long-term growth appeal, as after all we have an aging population and they provide health and life insurance, which is likely going to increase as the population gets older. I have owned shares of Aviva in the past, although I foolishly or not invested in another financial company or London Stock Exchange, which hasn't generated as impressive of a return in the short-term period of which I've held both of them. The next stock is listed in the Ftse 250 and I believe it to be a very high growth stock with a strong dividend to back it up. They are a completely vertically integrated business, meaning that they manufacture, distribute and retail each part of their product assembly line. Furthermore, they retail and manufacture and distribute the miniature figures and games and are in a virtual monopoly. Although investors started to sell this out in favour of the vaccine value recovery. Nice. Although investors had started to sell this stock in favour of the vaccine value recovery plays, and I don't think this is justified, which has left it at a significantly lower price than it was this time last month. This stock is Games Workshop and they have a significantly higher price to earnings ratio than both the industry and the market, and the same applies to their price to book ratio, in which they have 10 times more than their industry. This suggests to me that investors are more willing to pay a premium on their stock, meaning they're happy to pay more even though they're getting less earnings in the business because they are very bullish on what the future will bring for the company or Games Workshop. Which would also mean that standard metrics for this stock would also suggest that this isn't a value stock. In the last 5 years, they've managed to grow their earnings by an average of 36.1% each year, with also growing profit margins of above 26%. Whilst higher than this time last year, this had stagnated for the last financial year, mainly due to the pandemic, as they do help operate their own retail stores, and that had certainly bode a somewhat loss towards their top line, although this was redeemed by their online sales. Furthermore, they had a trading update in the last month which suggested they are more resilient than ever, and that in fact this year they anticipate for the financial half that they will be getting £80 million at least of profits, compared to just £59 million of the last half in the last financial year. They have an incredible management and the business is well placed, meaning they're able to generate incredible returns on equity, returns on assets and returns on capital employed. GAW currently has a dividend yield of 1.67%, typically paying in January, March, September and October, although this has been very inconsistent over the last few years, so without a doubt I imagine that these months will change somewhat until they find that routine, and then I would be able to forecast it for the future, for example. I very much anticipate their next dividend, their Q3 dividend, to be announced within the month, which will then give us an insight onto how well they are performing. I believe, and this is my prediction, which will either age well or it really won't, that they will grow their Q3 dividend from 35 pence to 50 pence, which is a significant markup, but I believe that they will do so. Regardless, in the last 20 years, they've managed to pay a dividend for the last 17 years, albeit at a very high volatility. However, more recently in the last 10 years, even though this did still remain volatile and there has been a few dividend cuts and suspensions during this time period, they've managed to grow their dividend by a compound annual growth rate of 20.4% in the last 10 years, which is much higher than the average market rate and is one of the best in the Ftse 350. This is whilst also maintaining a payout ratio of 66%, which you may argue is on the high side and therefore unsustainable, but this is a company that is growing at very fast paces and is also a very high cash generative business. Games Workshop has a fantastic balance sheet in which their short-term assets outweigh their short-term liabilities and long-term liabilities combined. Furthermore, they have absolutely zero debt and a strong cash position, which is well over £52 million, meaning that without a doubt they're likely going to be paying dividends for the next few years to come, and say for the extreme example that they suddenly lose a lot of their earnings, that they have the capital available to have cash runway, but also continue paying a dividend should they want to do so. And this is proven by the fact that during the peak of the pandemic, where the furlough scheme was started to be offered, the Games Workshop had actually decided that they did not need it and therefore paid back the government and furloughed their employees with their own cash reserves. If you'd have owned Games Workshop in the last 5 years, you would have gotten returns of over 2,000% with dividends reinvested. And whilst sure, I can't see this growth being sustainable and staying at such a fast pace, I could definitely see it being at least 10 times less, which is still a fantastic return over a 5-year period and will still outperform the markets. And I don't think it's the end of their growth, because they have got tons of IP or intellectual property which rivals that of Blizzard, Activision, who own Call of Duty, Overwatch, World of Warcraft, and I think they have more. This gives them potential as an entertainment business to move into films and a TV series. And this is combined with a virtual monopoly of their products in which they don't have any competitors in that segment. And if you sign up to Trading 212 using my link in the description down below, you can get a free share worth up to £100 when you deposit just £1, which could give you a kickstart to your portfolio and allow you to buy some of the stocks mentioned. Cheers. I am actually invested in Games Workshop and they are the second largest position in my portfolio, only behind Boohoo. The third stock is listed in the Ftse 100 and I would consider to be a value recovery play. This is because investors had decided to sell out, likely due to the fact they believed it was a very resilient pandemic stock, much like Games Workshop, and therefore sold out. This is combined with their trading update not being as great as expected, and therefore sentiment had significantly lowered. This has pushed their price to a point in which they are as low as the pandemic crash. They provide cloud accounting solutions and services, and I think this is a very staple business to be holding in such a time, and that businesses aren't just going to change their payroll and accounting software. This company is called Sage. They have a higher price to earnings ratio than the market, but not the industry, which tells me that investors aren't as bullish on this company. This is because Sage had been historically very slow to adapt and innovate, and only now are they investing more money into the future and therefore their technology aspect, which could be that value recovery play which I'm mentioning. In the last 5 years, they've managed to grow their earnings on average by 12.5% each year and have had very solid profit margins. Regardless, they have a solid return on equity and return on assets that is better than the industry, although return on capital employed has lowered over the last 3 years. Sage has a dividend yield of 2.83%, typically paying in June and February each year. And in the last 20 years, they've managed to pay and grow their dividend every single year. Furthermore, in the last 10 years, they managed to grow their dividend by a compound annual growth rate of 8.26%, although in the last 2 years, it has only just been above inflation of 2%, suggesting to me that they usually are reliable and do have significant growth, but at this time period, I imagine they're investing more money back into the business for technological advancements so that they don't get further behind and therefore hopefully get ahead of their competitors. Sage has a great but not amazing balance sheet. This is because their short-term assets do outweigh their short-term liabilities and their long-term liabilities, but not combined. They do have moderately high debt to equity ratios in which they haven't really been reducing their debt, but only increasing their equity, but it is backed up by a fairly substantial cash position, which pretty much covers their debt, which is redeeming for the balance sheet and bodes well for dividend investors, as you know that if their earnings should decline further, that they will be resilient and be able to pay it. If you'd have bought shares of Sage in the last 5 years, you would have gotten returns of 12% with dividends reinvested, but that's also accounting for the fact that over the last month they've dropped by well over 12%, and therefore they are still somewhat priced down. If they are able to successfully and continually invest this cash that they are using back into technological advancements, then I think they could be a good recovery play for the future. And then I would then believe it is a must hold in your portfolio, but at the moment there's a little bit more speculation towards it. And if you're interested in how many shares of a stock you need to hold for just £100 of dividend income each month, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.